In this video, we're going to discuss how to test the effectiveness of internal controls for the payroll cycle. In our last video, we discussed the design of internal controls. In this video, we're going to test the effectiveness of the controls, and we're going to do that by going over each and every internal control and asking ourselves two questions. Is the control operating as designed? And is it being performed by an employee who has both the ability and the authorization to perform the control? Now, there are several different ways to test internal controls. We can inquire among client personnel, asking them questions. We can observe the client actually applying the control, but just watching them do it. We can inspect the client's documents, for example, looking for things like signatures on timesheets. We could reperform the control ourselves, and we can conduct a walkthrough, which would involve several of these steps. Now, whenever possible, we want to do dual direction tests. Okay, now here's an example of what I mean by dual direction tests. Let's say that we're trying to check that the client is paying actual employees for actual time worked. So that's a very important thing with the payroll cycle. Now, if we're trying to do that and we think about the existence assertion, we want to make sure, okay, did these recorded liabilities actually occur? For example, maybe it's a fictitious employee. Well, what we could do is vouch a sample of paychecks back to the timesheets. So we take a paycheck and let's say it says, okay, this employee worked 40 hours and they got paid a certain amount. We go back, right? We vouch that paycheck back to the supporting document, to the original timesheets to see, is there in fact a timesheet that says that that employee worked 40 hours, and we want to look for a signature of their supervisor and so forth. Now, we could also go the other direction. So we went from vouching, going back, right, to the original supporting document. But if we're testing the completeness assertion, which is have all the liabilities actually been recorded, what we could do is trace a sample of timesheets. So now we're taking the timesheets and we're going forward and seeing whether they were recorded appropriately in the payroll journal. So we went two different directions, okay? We vouched the paychecks back to the supporting documents, and then we went to the timesheets and we actually traced them forward all the way through to the journal entry. So that's what we're talking about with dual direction tests. Now, what we're going to do next is we're going to discuss some specific controls, internal controls for the payroll cycle, and how the auditor would go about testing those internal controls. Now, in this column right here, I have the management assertion. And then here in this column, we have the potential misstatement. And then here we have the internal control that the client would ideally have in place. And then this column, the test of the control. So this column is about what the auditor would actually go and do to test that that internal control is working, it's operating effectively. So when we get to occurrence, remember, we're worried about things like fictitious employees, or someone was fired, they were terminated, and then someone kept them on the payroll, kept issuing them a paycheck, or we're worried about actual employees who are being paid when they actually haven't done any work. I mean, it's a real employee, they just didn't do work. So in terms of the internal controls, we had talked about one of the most important things in the payroll cycle, segregation of duties. So the auditor wants to go and actually observe and see, in fact, is there segregation of duties? Have duties been segregated? Or is it no, that there's just one employee who's doing all the different things of the payroll cycle, or several steps when they should not be? The auditor also wants to go and see if there is actually a report being issued whenever there are changes made to the employee's address, wage rate, things like that. So you don't want, for example, someone gets fired and then there's a dishonest employee who says, oh, well, I'll just keep paying them. I won't remove them from payroll. And then I'll change their address to my address. So then I'll take their check, right? And I'll steal that. So there should be a report issued whenever there are changes made to someone's employee information, to the employee master file. But the auditor needs to verify that report is actually being sent and that whoever it's being sent to is actually taking a look at it. Now, in terms of tracking people's time, whatever the system that the company or that the client uses, the auditor needs to go and see, okay, in fact, do they have some way of tracking employees' time? And is it something that could be effective to make sure that if actually someone says they work 40 hours, that the company has some way of verifying that? Now, in terms of the timesheets, which would be for hourly employees, saying, oh, okay, this employee worked 35 hours, for example, we need to inspect the timesheets so the auditor can look at a sample of them to look and see, is there a signature from the supervisor of the employee? Now, the company, if they actually distribute physical payroll checks, They should be requiring people to show ID when they get their payroll check, and the auditor can go and verify that they are in fact checking IDs. They're using pre-numbered payroll checks and so forth. Okay, so we're still on the occurrence assertion here. We'll get to completeness in a second. Now, the company should have, the client should have a procedure for removing people who've been fired promptly so they don't continue to receive checks. And so the auditor can go and verify that there is actually a system for removing someone in a timely manner so that we don't have someone leaving a fired employee on the payroll and then stealing their check. Now, the client would ideally be mailing earnings statements in the US, for example, a W-2 in the United States, that's what we call an earnings statement, to the employees, and the auditor can go and check and see, in fact, is the client mailing earnings statements to employees. Now, in terms of completeness, remember with the payroll cycle, there's not usually, like employees will complain if they don't get paid. So the main issue with completeness has to do with disclosures. So you want the client verifying if they have a lot of executive compensation, share-based compensation, they're making the appropriate disclosures. The auditor should have their own disclosure checklist and verify that the client is actually going through and making the appropriate disclosures and so forth. So now, when it comes to authorization, remember that authorization, very important assertion for payroll, because we don't want just anybody to be able to add people to payroll. And we don't want just anybody to be able to increase the salary of someone on payroll, anything like that. We don't want people you don't want to have a ton of different people who can just go and make changes to the payroll system. So the auditor should go through and very carefully review who in fact is authorized to go and add people to payroll, remove people from payroll, change their pay rate, things like that. Okay, don't worry about this information on the side here for the moment. Let's keep going down the list. I just ran out of space. Now, in terms of the accuracy assertion, we want to make sure gross and net pay have been calculated correctly. In internal control is that the client should be going through and looking for unusual amounts. What can the auditor do? The auditor can use audit data analytics software to check for unusual amounts. Just one example that I have here would be that if you had an employee that didn't have any voluntary deductions from their paycheck, that's kind of unusual. So the audit data analytics software could quickly flag that. In terms of making sure that the client is actually comparing actual payroll costs to either what was budgeted or what the standard cost should have been to look for any discrepancies. So the auditor should go through and see, in fact, is there any evidence that they actually go and look at what the labor costs were and then compare them to what they should have been? Because just them saying that, yeah, we have that internal control in place, but yeah, is there any evidence that they're actually doing that? Okay, now, when we come up here to cutoff assertion, we want to make sure, obviously, that payroll transactions have been recorded in the appropriate period. In terms of classification, we want to make sure that the payroll transactions go to the right accounts. For example, if we have a manufacturer and we're talking about labor costs that have to do with production, right? Those are going to go to inventory and eventually the cost of goods sold, versus if the costs don't have to do with production, their period costs, they're expensed immediately. They don't go to inventory. So we want to make sure these things are coded to the correct accounts. So what the auditor wants to do is verify that in fact the client has a chart of accounts, that they're reviewing the chart of accounts. They can look at some transactions, right? The auditor can go look at some transactions. They compare that to the chart of accounts and see if these accounts are being coded appropriately. Now, when the auditor has gone through and they have looked and they've done all the tests of internal controls, they've gone through all the internal controls, the auditor is going to set the achieved level of control risk, right? Before they did any tests, they had an idea what they thought would be the level of control risk, but then they go and actually test the operating effectiveness of the controls, and they say, okay, now we know the achieved level of control risk. Now, if that achieved level of control risk is lower than what the auditor had expected, so they say, oh, wow, it's actually control risk is not as high as what we thought, then the auditor will not need to perform as many substantive procedures. But if it's the opposite, if you go and you say, actually, the achieved level of control risk is a lot higher than expected, maybe some of these internal controls were not operating like we thought they would, then what the auditor needs to do, the auditor needs to increase the amount of substantive procedures in order to reduce detection risk and keep audit risk at an acceptable level.